Welcome to Mauuak Saving Tips. In today's discussion, we're rediving into how various Trump administration policies have contributed to growing economic uncertainty in the United States. Finance, as always, remains a dynamic field, whether it's the bond market, stock market, corporate, or municipal bonds, but the central issue boils down to the supply of capital. When capital is abundant, it's cheaper to borrow, which helps fuel economic growth. Even before Donald Trump took office, America was already on the edge of a significant economic transition, primarily driven by demographics, specifically retirement. As people retire, they move their money from riskier investments like stocks into safer options such as T-bills and cash. This shift affects the capital markets. Because retired, individuals stop contributing to investment portfolios and begin withdrawing from them. For example, younger investors may have seen their portfolios drop 10 to 20% recently, but they still have time to recover. Retirees, however, don't have that luxury. If they hadn't already shifted their savings, they're now facing permanent losses while still needing to draw from those diminished accounts, which could lead to financial distress in just a few years. This demographic wave is particularly important because baby boomers, the largest generation in U.S. history, are either already retired or about to retire within the next few years. This means a shrinking pool of people actively saving for retirement and a growing group withdrawing funds. It's causing pressure on capital supply and rising credit costs. While some blame can be attributed to policy decisions under Trump, Biden, or the Fed, the real driver behind the recent quadrupling in credit costs is largely demographic. We've seen this shift coming for decades, yet neither governments nor financial institutions adequately prepared. On top of this structural challenge, we have policy instability. Under Trump, the U.S. introduced 97 new tariff policies in just 55 days, an unprecedented rate, creating confusion in global trade, with contradictory statements from the administration about trade deals. Tariffs and regulations industries have been paralyzed, unsure how to plan for the future. Industrial construction, vital for a high-tariff economy, has essentially stopped because businesses don't know what to expect next. Furthermore, President Trump has strained international relationships by threatening countries like Canada and Greenland and suggesting withdrawal from key military commitments, which has undermined global trust in the U.S. This unpredictability discourages foreign investment in U.S. assets. Although the U.S. dollar remains the global reserve currency, the Federal Reserve can intervene to prevent financial disaster. There's still a significant shift occurring. Historically, about $2 trillion flows into the U.S. annually from global capital markets. This is because Europe faces low returns due to its aging population, and China's capital is heavily regulated and politically manipulated. However, these flows are now under threat. The Middle East, which has tried to build alternative, Sharia-compliant financial systems, is running into the limits of that approach. Major oil producers like Saudi Arabia are now overextended financially and co-invest abroad like they once did. East Asia, particularly Japan and China, still sends capital to the U.S., but this may decline slightly due to trade tensions and emerging alternatives. The most dramatic shift is happening in Europe, where Trump's foreign policy has made the U.S. appear more like a security threat. As European countries prepare to defend themselves independently, including potentially developing nuclear weapons, they are also pulling their capital back. Whereas the Eurozone used to send around $1 trillion annually into U.S. markets, that figure has likely dropped to zero or even reversed. Combine this with the capital drawdowns from retiring baby boomers, and you get a serious squeeze on available investment capital. This shrinking capital supply raises the cost of borrowing across the board, whether you're a business, a consumer, or the federal government. Adding to the problem, the U.S. dollar has dropped 10 to 15% during this period, compounding the challenge. All these factors mean that financing in America is getting significantly more expensive, and that trend is likely to continue.